Welcome back to The Deep Dive, the show where we take a stack of complex source materials, the foundational frameworks, the risk models, the valuation formulas, and build you an instant, high-octane shortcut to being truly well-informed.
You brought the material, and we bring the insight. And today, we are really tackling the fundamental architecture of professional investing
We are. Our mission is to move beyond the surface level, beyond the headlines and the noise.
and decode exactly how analysts define, measure, and ultimately assign value to a stock. We're going from that high-altitude macroeconomic view right down to the nitty-gritty metrics.
Yeah, the specific formulas they use to decide if a share price is actually justified. And this deep dive is explicitly tailored for the learner,
Right. Someone who is ready to absorb the structure, the mechanics of finance.
someone who needs that clarity and those critical aha moments, but without getting, completely buried in jargon.
Well, our sources are a pretty comprehensive guide to equity analysis, and they lay out a very structured, step-by-step process that, you can adopt immediately.
The ultimate goal of this entire deep dive is, well, it's simple on the surface, isn't it? It's just determining if a stock is a good investment opportunity.
It sounds simple, but answering that requires internalizing a distinction that is absolutely critical. It's a theme we're going to keep coming back to.
And what is that?
It's the massive difference between price and value.
Okay, let's unpack that. Price.
Price is simple. It's a fact. We know what it is because the market is screaming it at us every second of the trading day.
It's just the number on the screen.
Exactly. But value, that's a different beast entirely. Value is an opinion.
An opinion.
An informed opinion, sure. One that's built through a really rigorous process of analysis. It incorporates future earnings, risk, economic cycles.
Corporate strategy, all of it.
All of it. And we're going to unpack exactly how that influential, that powerful opinion is formed.
Okay, let's start at the very beginning. Let's unpack this foundational layer, starting with the nature of equity itself. What is it, and why does it sit where it does in a company's financial structure?
Well, when a company needs to raise capital, our sources tell us they can issue two broad types of securities. The first one is debt.
Right. Borrowing money. You're a lender.
It's a lender-borrower relationship, pure and simple. But the second is equity. And the question is, what does owning equity truly give you, the investor?
It's not just a piece of paper.
Not at all. It means ownership. And that ownership comes with specific, powerful rights that a creditor, a debt investor, a bondholder simply does not have.
Such as?
Well, for starters, equity investors, especially if they own a sizable stake, gain voting rights.
So you just say,
You get to say in major corporate decisions, you get the opportunity to participate in the strategic direction and the management of the business. You are literally buying a piece of the operation.
that gives you influence, maybe even a degree of control.
It does. But with that power comes a significant inherent risk, and that risk is tied to a crucial concept that really defines the shareholder's fate.
And that would be the residual claim.
The residual claim.
Yeah.
Yes. Can I define that for us?
Please do. What are the practical consequences of being a residual claimant?
It defines your position in the line. The equity holder is the last claimant on the company's assets and its earnings.
Last. Not second to last. Dead last.
Dead last. Shareholders have a claim on the company's net assets, but only after all other liabilities, obligations, and creditors have been satisfied.
So think of a failed business.
A bankruptcy, exactly. The bank gets the building back, the suppliers get paid for their raw materials, employees get their final paychecks.
And whatever's left over.
If anything is left over, that residual scrap belongs to the shareholders. And if the business fails spectacularly, which they often do, the shareholders usually get nothing. Zero.
And that position being last in line, that explains everything about the risk and the required return, doesn't it?
It's the whole ballgame. Unlike debt, the company has no contractual obligation to repay the amount it received from you, the shareholder.
And they don't have to make periodic interest-like payments either.
No. They only pay dividends if they're profitable, and if management decides it's a good idea to declare one, it's completely discretionary.
So you have no guarantees.
None. That inherent lack of contractual protection and that residual status are precisely why the expected return on equity must be substantially higher than on debt.
You're taking the biggest risk. You expect the biggest reward.
You, the equity investor, are bearing the highest risk in the entire capital structure. So you expect compensation that is commensurate with that risk.
And if you're successful, that return comes in two main forms.
Right. Primarily capital appreciation, so the growth in the share price, which is largely driven by market demand and future expectations,
And
and dividend income, shared profits, which again are entirely dependent on the company's profitability and those discretionary management decisions. Hashtag 2, risk mitigation through diversification.
okay, so since equity is inherently risky, that's the whole point of being the residual claimant, the professional analyst's next logical step has to be mitigating those risks where possible.
Of course. And our sources stress that old adage, don't put all your eggs in one basket.
But they break it down. They categorize risk reduction
Mm.
into two distinct, sort of complementary dimensions that you, the learner, really need to grasp.
The first dimension is the one that's pretty intuitive for most people. It's cross-sectional diversification.
Meaning,
It means investing across different business sectors, different geographies, companies of different sizes.
so don't just buy a bunch of tech stocks based in California.
Please don't. The key conceptual driver here is low correlation. The idea is that different sectors, say technology and utilities, don't generally behave the same way at the same time.
So when one is down, the other might be up.
Or at least stable. It neutralizes the portfolio's overall swings, and the research is really clear on this. By simply holding equities in many different sectors and geographies, a huge portion of that portfolio's specific risk can just be eliminated.
Okay, so if cross-sectional diversification deals with what you buy, the second dimension deals with when and for how long you hold it.
That's time series diversification. Or, the power of time in the market.
Not timing the market.
Definitely not timing the market. This strategy just assumes that the inevitable, sometimes severe bad market periods will be canceled out by the good periods over a long enough duration.
So it's about patience.
It's a strategy based on patience and the mean reverting nature of economic cycles. Equity prices are incredibly volatile in the short run, so analysts strongly discourage trying to time the market perfectly.
Because it's a fool's errand.
It really is. Duration, just being in the market, is a much more reliable risk reduction tool than trying to predict the daily or weekly swings. Hashtag 3, classifying business types and risk.
Moving on, the analyst has to understand how different businesses react to the overall economic environment, the business cycle.
Absolutely. Classifying companies by their cyclicality is it's crucial for forecasting their future cash flows and their risk.
So you're distinguishing between businesses whose performance just tracks the broader economy and those that kind of resist it.
Exactly. You have your counter-cyclical or defensive businesses. These tend to reach their peak performance when the broader business cycle is at a trough, or even in a recession.
What kind of businesses are these?
They sell non-discretionary goods or services. Things consumers have to buy regardless of how the economy is doing. Think basic groceries, utilities, essential pharmaceuticals.
The recession-proof stuff.
Or at least recession-resistant. These are the firms that can maintain or even improve performance during an economic downturn.
And then on the other side, you have the ones that sort of amplify the cycle.
Yes. You have leading sectors. These are the ones that recover from a recession faster than others. They often include sectors that are sensitive to interest rates or capital expenditure.
So they act as a signal for the broader recovery.
That's right. Conversely, you have lagging sectors. They might enter a recession later than the rest of the economy, maybe because they rely on long-term contracts or specific commodity pricing that buffers them from the immediate shock.
And understanding where a business sits in this whole cyclical spectrum is key.
It allows the analyst to apply the right risk premium and to forecast their trajectory with much more accuracy. Hashtag 4, categorizing equity risks, the 5 threats.
Okay, now let's get really specific about the threats to equity value. Our sources list 5 main categories of risk. The first one is the big one, the fundamental, unavoidable systemic risk. Market risk.
Market risk. This refers to price fluctuations caused by broad dynamics, things like policy shifts, geopolitical crises, systemic banking failures.
Things that affect all listed assets.
All of them. It's the risk that is inherent in the overall system. If the entire market crashes, even the best, most well-run companies will see their stock prices plummet, at least temporarily.
And the proxy measure, the number of professionals used to determine the degree of impact market risk has on a specific stock, is beta. Can you unpack beta for us?
Sure. Beta is the standardized measure of a security's sensitivity to the overall market's movement. A beta of 1.0 means the stock moves, on average, exactly in line with the market.
So if the market goes up 10%, that stock goes up 10%.
Correct. But here's the practical implication. If a stock has a beta of 0.5, a low beta, It suggests that if the overall market falls by 10%, that stock is only expected to fall by about 5%.
Those are your defensive, low volatility stocks,
Yeah.
the ones you want during a downturn.
Exactly. Conversely, a stock with a beta of 2.0 is highly sensitive. If the market rises 10%, that stock should theoretically rise 20%.
But if the market drops 10%,
It's expected to drop 20%. These are your aggressive, your cyclically sensitive growth stocks, big swings in both directions.
and crucially, because this risk is systemic, it affects everyone.
It cannot be diversified away. You can't get rid of it by buying more stocks. You can manage it through sophisticated hedging strategies or by selectively picking stocks based on their beta, but you can't eliminate it.
Which fundamentally distinguishes it from the next type of risk, which we can eliminate.
Which is idiosyncratic risk. It's also called sector-specific risk. This is the risk that arises from factors that only affect a particular industry. For example, a sudden shift to remote work heavily affects commercial real estate and business travel.
But not, say, domestic packaged food manufacturers.
Precisely. This is the easy risk to manage. It is easily diversified away simply by making sure your portfolio holds securities across many different uncorrelated sectors.
Simple enough. Then you have risk at the most granular level, which is company-specific risk.
Right. And that's risk that is unique to a single firm. These are risks that don't inherently affect its competitors.
Like what?
This category includes things like poor management decisions, the spectacular failure of a key product line, or, corporate debacles like internal fraud or regulatory sanctions.
And you manage that through deep, fundamental company analysis.
And a qualitative assessment of the management team. You have to trust the people running the show.
Okay, the next two risks relate directly to the act of trading itself. Let's start with transactional risk.
Transactional risk is the risk that a counterparty, the person on the other side of your trade, fails to fulfill the contract terms.
So they failed to deliver the shares or the cash they owe you.
Exactly. Now, this risk is largely mitigated by transacting through regulated stock exchanges. They act as central clearinghouses and guarantee the trade.
So the exchange itself steps in.
It does. Our sources highlighted that in highly robust regulated systems like major global exchanges, there are sophisticated risk-clearing procedures that ensure neither the buyer nor the seller faces a loss due to the other party's default.
So it's a much lower concern for the average investor than, say, market risk.
Much, much lower.
And finally, a risk that is critically important when dealing with smaller companies or more exotic markets. Liquidity risk. How do we measure that in practice?
Liquidity risk is measured by something called impact cost.
Impact cost.
It's defined as the percentage price movement caused by a specific order size. So let's say a major institutional fund needs to sell $20 million worth of a stock. If that single order causes the price to immediately drop by 3%, that 3% is the impact cost. A high impact cost indicates a stock is less liquid, it's thinly traded.
Meaning one big trade can move the price significantly.
Exactly. And that makes it prohibitively expensive for large institutional investors to get in or out of a position without moving the market against themselves.
Okay, before we move on, we should quickly touch on those macro risks that specifically impact markets open to international trade.
Right. That's primarily currency risk, which arises from volatile exchange rates. This mainly affects international institutional investors, or what we call foreign portfolio investors, FPIs.
And their buying or selling can be driven by things completely unrelated to the company itself.
Completely. FPI buying or selling pressure is often driven by external factors, say a change in interest rates in their home country, which suddenly makes local assets more attractive.
Or just an unfavorable shift in the exchange rate that erodes their profits when they convert the money back home.
Precisely. And beyond currency, the major domestic macro factors that affect everyone are, of course, persistent inflation, volatile fuel prices, and overall economic growth or slowdowns.
So we've established what equity is and where the fundamental and systemic risks lie. Now we can move into the actual research process that analysts use to determine that magical, elusive value number.
And the entire process is aimed at one thing: determining the intrinsic value of a stock and then comparing it to the current market price to formalize a buy, hold, or sell recommendation.
But who is doing the research? It profoundly influences the incentives and the final output.
It really does.
Our sources clearly delineate the two sides of equity research, the sell side and the buy side. And the goal for you, the learner, is to understand the inherent biases and pressures of each group.
Let's start with the sell side. These are the analysts who work for investment banking, broking, or advisory firms.
The research is often public, right?
Right, their output is often public, it frequently includes a price target, and it's distributed widely to clients. And because they serve so many clients, their research often has an underlying marketing component.
So,
Well, it supports the firm's brokering activities and often aids the investment banking division in underwriting deals. There's a sales element to it.
whereas the buy-side research is much more focused, exclusive, and internal.
Correct. Buy-side analysts work for asset managers, mutual funds, hedge funds, pension funds. They generate investment recommendations exclusively for their own internal funds.
And the critical distinction, a major insight for the learner, is why buy-side research is often considered to be, well, under more pressure to be accurate.
The pressure is immense because the firm's own capital or their client's dedicated capital is directly at stake. The pressure for precision, for rigorous modeling, for finding genuinely differentiated insights is exponentially higher than in the sell-side environment.
But doesn't the buy-side face a different, maybe more insidious pressure? The pressure of herding?
Ah, that's a brilliant point.
I mean, if every smart buy-side analyst reaches the same accurate conclusion, their collective action of moving massive amounts of capital into that stock pushes the price up and potentially eliminates the very value they were trying to find.
You've hit on the core challenge of the buy side. The pressure isn't just for accuracy, it's for differentiated accuracy.
An edge.
They need insights that the rest of the market and their competitors do not have. Otherwise, they just become part of the market friction they're trying to exploit. If everyone agrees a stock is undervalued, it won't be undervalued for very long.
Both sides, though, ultimately rely on fundamental analysis. This is the process of determining a stock's intrinsic value based on all those underlying economic factors.
Right. Future earnings potential, prevailing interest rates,
Yeah.
specific company risk variables, the whole shebang.
And the core philosophical belief that unites every fundamental analyst is what?
It's that while the market price may deviate significantly from the intrinsic value in the short term due to sentiment or volatility, the price will eventually converge with that intrinsic value.
The market is emotional in the short run, but rational in the long run. That's the idea. In the long run, fundamentals win. This provides the entire rationale for the process.
And to conduct this analysis in a structured, professional, and repeatable way, analysts use a standard three-stage approach, the EIC framework.
Economy, industry, and company. This framework mandates that the analysis moves logically from the broadest possible macro trends down to the minutia of the individual firm.
Because you can't understand a single company without understanding the world it operates in.
You simply can't.
All right, let's start with the economy, the E in EIC. This is where the analyst has to choose their path, a top-down or a bottom-up approach.
The top-down approach starts high. You scan the global and domestic macroeconomic scenario.
What's happening in the world?
Exactly. Then you identify the sectors or industries most likely to thrive in that specific scenario, say high inflation favoring commodity producers.
And only then do you pick the individual companies within those attractive industries. Right. The bottom-up approach is the reverse. You find a fantastic company, first one with unique competitive advantages.
And then you check to make sure the macro environment isn't going to crush it.
You treat the macro environment as a risk filter rather than a primary driver. Both are valid, they just prioritize different things.
But regardless of your starting point, you have to understand the key macro influences.
Yeah.
What are the biggest policy levers that get pulled on corporate performance?
Two main levers: fiscal policy and monetary policy.
Fiscal policy is government spending and taxes.
Right, it can encourage business expansion through tax cuts or discourage it through new taxes. But honestly, monetary policy, controlled by the central bank, is a more powerful and immediate influence.
Because it hits the money supply and interest rates directly.
It does. A policy designed to reduce the money supply immediately affects the working capital and expansion plans of businesses by making borrowing more expensive, which can also slow down consumer demand.
And here's where we see that crucial link to valuation. When a central bank raises interest rates, it doesn't just make a company's loans more expensive.
Oh, it's much bigger than that. It instantly changes the denominator, the discount rate, in every single valuation model across the entire stock market.
So it lowers the calculated intrinsic value of basically everything.
Across entire sectors, yes. It's a systemic consequence. So, if you're forecasting the future, the four key numbers an analyst must track without fail are GDP, inflation rates, interest rates, and unemployment.
Our sources highlight the importance of tracking inflation, using both the WPI and the CPI. For the learner, why does a professional need to track both? producer costs and consumer costs.
Because they tell us two very different stories about profit margins. Monitoring the WPI, the wholesale price index, tells you about input costs and production prices.
So the pressure on the business itself.
Exactly, the cost of goods sold. But the CPI, the consumer price index, tells you about consumer spending power and ultimate demand.
So if WPI is rising fast, but CPI is stable.
That means producers are eating the costs and their margins are shrinking. If both are rising, it means producers have the pricing power to pass those costs on to you and me. You need both to understand where the pain or the power is emerging.
And finally, the stock market itself. We always hear it referred to as a leading economic indicator. Why is that?
Because the stock market is inherently forward-looking. Stock price decisions reflect future expectations of economic activity. It often anticipates a recovery or a downturn before the actual economic data, like GDP or employment, shows the shift.
The market moves on anticipation, not just on current results.
That's it in a nutshell.
Okay, moving from the macroeconomy to the specific industry, the I in EIC.
Yeah.
We've already touched on cyclicality, but let's look at the mechanics of industry performance during an expansion.
Right, we need to categorize them. You have your cyclical industries, which align with the economy. They're very attractive during the early stages of an economic recovery.
Because they have the most room to bounce back after being hammered in the downturn.
Exactly. And then you have your non-cyclical or defensive industries, which we discussed. They are the safe havens during downturns.
What about industries that rely heavily on physical infrastructure and have high fixed operating costs? How do they behave when the economy expands?
Oh, industries with high fixed operating costs benefit tremendously from economies of scale during an expansion.
Explain that.
Well, as their sales increase, they can spread those high fixed costs like factory depreciation, large machinery leases, extensive R&D facilities over a much larger revenue base.
Which leads to disproportionate increases in profitability.
It's called operating leverage, and it can be incredibly powerful on the way up.
And who are the darlings at the peak of the cycle when global commodity inflation is running hot?
That's when industries producing basic materials, oil, metals, industrial chemicals, are favored. They often have the pricing power driven by inelastic demand and global supply constraints to easily pass inflation costs on to downstream consumers.
Protecting or even expanding their margins.
Absolutely.
Now, beyond cyclicality, analysts have to place an industry within its life cycle. Our sources list 4 stages that define the competitive reality.
Right. First, you have the nascent introduction stage, very new. Second, the growth stage. This is characterized by rapid expansion, low competition because the market is still developing.
And generally high profit margins.
Very high. Companies are just focused on grabbing market share here. Third is the maturity stage, which is usually the longest phase of the cycle.
Growth slows down, competition heats up.
Intensely. Firms get hyper-focused on efficiency, optimization, and just protecting their market share. Finally, you hit the decline stage.
Where there's a structural decline in sales due to shifting demand, maybe technology becomes obsolete.
And profit margins come under severe pressure. This often leads to consolidation or companies just exiting the business altogether.
This brings us to the final and most specific step, company analysis. The goal here is to identify the best firms within those desirable industries and then figure out if they are attractive right now in terms of risk-adjusted returns.
And this step really crystallizes that core paradox we started with. A good company may not be a good investment.
Right. A company with amazing products, a strong brand, brilliant management,
Could be trading at a market price much higher than its calculated intrinsic value. And in that crucial gap, the investment decision becomes unattractive, even if the underlying business is phenomenal. Price matters.
So how do we assess the actual health of the firm and determine that intrinsic value?
Well, we begin with a forensic review of the 3 core financial statements: the profit and loss account, the balance sheet, and the cash flow statement.
That's the raw data.
That's the raw data. But the analysis has to go deeper, using qualitative tools like SWOT analysis.
SWOT analysis.
Yeah.
Strengths, weaknesses, opportunities, and threats. We're looking at internal and external factors to identify durable competitive advantages and structural weaknesses.
Exactly. Internally, you assess strengths and weaknesses factors the company controls, like its intellectual property or, say, its outdated infrastructure.
And externally, you look at opportunities and threats.
Right. And external threats could be anything from stringent government regulation that increases compliance costs to the emergence of a large predatory competitor or rapidly changing technology that could make their core products obsolete.
And this qualitative SWOT analysis must directly dictate the hard numbers we use in our valuation models. How does an analyst translate, say, a strength into a higher valuation?
That's the key step. Let's use a concrete example. If a company's strength is a unique patent that blocks all competitors from a high-margin market,
Okay.
an analyst translates that into a hard number by assuming a higher sustainable profit margin in their model or, even more critically, a higher terminal growth rate in their DCF model.
Because that strength gives the company a durable competitive advantage that lasts for the long term.
Precisely. Conversely, an external threat, like new complex policy uncertainty, might force the analyst to increase the discount rate to account for that greater policy risk.
And this analysis dictates the company's strategic response, doesn't it?
It has to. A firm might adopt an offensive strategy, using its strength, like a strong balance sheet, to actively affect the competitive forces in its industry, maybe by launching a price war.
Or they could play defense.
Or adopt a defensive strategy, positioning its capabilities to deflect the effects of those competitive forces, maybe through aggressive patent defense, or by securing long-term supply agreements to protect their margins.
We've built the blueprint. We understand the economy, the industry, and the specific company mechanics. Now we have to put a price tag on that intrinsic value. This is the quantification challenge.
And as we established, this entire exercise hinges on recognizing that fundamental difference between price and value.
Price is a fact. It's known to the market, changes every second.
While value is an opinion, it's the analyst's calculated, justified estimate of what a company is worth based on all the factors we've discussed.
And the gap between the two is the opportunity the investor is trying to exploit.
That's the whole game. Now, our sources highlight 3 popular and distinct approaches to formal valuation, and each one is suitable for different types of businesses.
What are they?
They are discounted cash flow, DCF, asset-based valuation, and relative multiple-based valuation.
DCF is often seen as the theoretical gold standard because it cuts through decades of, accounting noise. What is the core logic, and why does it focus on cash flow rather than reported profit?
The core logic is simply the time value of money applied to real, actual cash flows. It focuses on the stream of future cash flows the company genuinely generates.
Cash that can be distributed to investors or reinvested.
Right, not just reported accounting profits.
Why is that distinction so necessary? Why are accounting profits sometimes so profoundly misleading?
Because profits are highly subject to accounting estimates. They involve accrual adjustments, non-cash charges like depreciation, and various policy choices like how you recognize revenue. It can get murky.
So DCF cuts through all that.
It bypasses the ambiguity to focus on the cold, hard cash available to the business, what we call free cash flow. If you can't touch the cash, it doesn't count in the model.
To run a DCF, what 3 requirements must the analyst provide, and why is the model so sensitive to these inputs?
The analyst needs the stream of future cash flows, so a detailed forecast, usually 5 to 10 years out. They need the precise timing of those flows, and they need the appropriate discount rate.
The required rate of return, which reflects the risk.
Exactly. And the model is notoriously sensitive to 2 of those factors in particular: the discount rate, because of compounding, and the terminal value calculation.
The terminal value, that's the value of all cash flows after the forecast period, right?
Yes, and it often represents 60%, 70%, even 80% of the calculated intrinsic value. A tiny error in that terminal growth rate assumption can swing the final valuation wildly.
And in which sectors is DCF most reliably applicable? Where does it work best?
It's best for non-cyclical sectors like pharma and FMCG, fast-moving consumer goods.
Because their cash flows are so predictable.
Their demand is stable, their cash flows are steady. It makes the forecasting exercise, which is the most subjective part of the DCF, much more reliable.
Okay, method number 2 is asset-based valuation. This is based on the balance sheet, but it has some very specific constraints on its application.
It does. It's typically used for asset-heavy businesses where the tangible assets are the primary source of earnings capacity. Financial institutions, real estate firms, commodity processors. And for extremely capital-intensive businesses like cement and steel manufacturing, analysts might even use a specific version called the replacement cost method.
What's that?
That involves calculating what it would cost to build or acquire the physical assets, the factories, the machinery, all over again today. It provides a more relevant floor value than the historical depreciated cost that's listed on the balance sheet.
So if it gives us a good floor value, why don't we use it for, say, high-growth tech firms? What's the primary limitation?
Its huge limitation is that it's static and historical. It does not recognize the value of future profits, future cash flows, potential innovation.
Or crucial intangible assets like brand equity or human capital.
Exactly. If you try to value a company like Google based on its desks and server farms, you miss 99% of its true worth. It tells you what you have today, not what you're going to earn tomorrow.
And this brings us to the method most often cited in the news and analyst reports, using multiples. It's valuation by comparison.
What are similar things selling for?
100%. Relative valuation determines the value of a company by comparing it to similar publicly traded companies using standardized multiples.
Like price to earnings or PE.
PE, EBITDA, there are several. It's quick, it's practical, but it's highly dependent on finding truly comparable companies that share similar growth, risk, and capital structures.
Conceptually, how do these simple ratios relate back to the complexity of a DCF model? Are they totally different?
Not at all. Multiples are essentially a simplified, standardized version of a DCF. If you rearrange the variables in a discounted cash flow formula, you find that the fundamental drivers growth, risk, profitability, they're all packaged into that single ratio, which is why understanding the sector attributes is so key.
It's everything. No one method is universally perfect. Different sectors respond better to different metrics. You would never value a tech startup using the same price-to-book ratio you use for a bank. Hashtag TAG, hashtag 5. Essential valuation, multiples breakdown.
Let's dedicate some time to the specific ratios, starting with the most famous one, the PE ratio, or price earnings per share.
The PE is calculated simply as the stock price divided by the earnings per share. It tells you how much the market is willing to pay for $1 of the company's current or expected earnings.
So a high PE implies the market expects high future growth.
Or that the company has a very low risk profile. Or both. Now, the distinction between the two types of PE is crucial for the learner.
Go on.
We use trailing PE, which uses the last 4 quarters of reported earnings, and the forward PE, which uses the expected earnings for the next 4 quarters.
And fundamental analysts prefer the forward PE.
They do, because their job is forward-looking. And relatedly, there's the earnings yield, which is just the inverse of the PE ratio. It's calculated as earnings per share divided by the market price times 100. It gives you a percentage return.
Okay, now let's talk about tying PE to growth using the PEG ratio. This is where we can find potentially undervalued stocks.
Yes. The PEG ratio is the PE ratio divided by the EPS growth rate. This is a critical adjustment because it normalizes the PE for the growth opportunity.
And how do you interpret it?
The interpretation is simple. A PEG ratio of less than 1 suggests that the stock might be undervalued relative to its peers, given its superior earnings growth rate. It implies you're paying less for an incremental unit of growth.
Next up is the price to book value, PBV. How do we interpret that, especially when looking at financial institutions?
PBV indicates how the market is valuing the equity recognized in the books, the company's accounting net worth, versus its current market price.
So if the ratio is 1.0, the market values the company exactly as the accountants do.
Exactly. If it's 3.0, the market sees significant intangible value. This ratio is widely used for financial services and banking stocks because their primary assets and liabilities, their loans and deposits, are often transparently listed and regulated on the balance sheet. It makes book value a very reliable baseline.
But the PE and the PB, they break down instantly if the company is losing money, which is common for startups. And that's where the price-to-sales PS ratio becomes indispensable.
That's right. The PS is calculated as the market capitalization divided by the company's total sales or revenue over 12 months. Its utility lies in the fact that it is usable for loss-making companies that haven't reached profitability yet.
And sales are harder to manipulate than earnings.
They are generally less prone to manipulation via complex accounting policies than earnings are, so it provides a more reliable comparative metric when profits are absent or highly volatile.
Finally, we need to understand a metric that accounts for both equity and debt holders. Enterprise value, EV, and EBITDA.
Enterprise value, or EV, is a truer theoretical takeover value of the business because it includes all sources of capital.
And the calculation is?
It's the market cap of the equity plus the market value of debt, any excess cash. We strip out the cash because an acquirer would receive that cash, effectively lowering the cost of the purchase.
And why do we use EBITDA earnings before interest, taxes, depreciation, and amortization in that multiple? Why that specific measure of earnings?
The EBITDA multiple is crucial for capital-intensive cyclical firms. EBITDA measures the operational cash available to both debt and equity holders before you subtract significant and often company-specific non-cash accounting charges like depreciation and amortization.
So it gives you a cleaner, more comparable view of operating performance across different companies.
Exactly, even if they have different tax structures or depreciation policies.
Okay, let's quickly define the last few concepts. Dividend yield is straightforward. Dividend per share divided by the market price per share times 100.
Simple enough. And then we have two advanced profitability concepts that look beyond simple accounting profit.
Which are?
First, economic value added, EVA. This is the true economic profit. It's calculated by taking the after-tax operating profit and then subtracting the cost of capital.
So it's not just about making a profit, it's about making a profit that's bigger than the cost of the money you used to generate it.
That's it. If EVA is negative, the company is actually destroying shareholder value, even if it reports a positive net income. And second, there's market value added, MVA. Which is the difference between the current market value of a firm and the original capital that was contributed by investors. MVA is a holistic measure of the cumulative wealth the firm has created for its investors since day one.
We've spent most of our time determining the intrinsic value. But valuation only tells you what something is worth. It doesn't tell you when the market sentiment is ripe for a price move.
Right, and that's where technical analysis comes in. If fundamental analysis is about determining the worth of the investment,
Technical analysis is about timing the trade.
exactly. We move from asking, is this house worth $500,000 to, is the auction crowd going to bid this price up or down in the next week?
So what is the core philosophical assumption that underpins all of technical analysis?
It is rooted in the belief that all available information, the fundamentals we just discussed, plus market sentiments, news, rumors, everything, is already reflected in the stock price.
So there's no hidden information to uncover.
Technical analysts believe the market price already knows everything.
So how do they forecast the future if they're ignoring the balance sheet and the P&L?
They forecast future price direction by studying patterns in historical market data, specifically price and volume. They believe that history tends to repeat itself and that market psychology leaves these identifiable predictive patterns on the charts that can be exploited for short to medium-term timing.
I love the analogy our source material gave us to distinguish the two approaches. It said, fundamental analysis is like checking the blueprints and the plumbing of a house to determine its fair market value.
It identifies the stock.
Right. Whereas technical analysis is ignoring the blueprint completely and focusing only on the crowd at the auction.
You're watching the speed of the bidding, the volume of the crowd, the psychological momentum to predict which way the price is moving right now. It is used exclusively for timing the entry or exit point.
So what are the three essential elements technical analysts look at to build their models?
Price history, trading volume, and the time span of the observations. These elements form the basis for all their quantitative tools, which are designed to smooth out the noise and identify trends.
Let's discuss a few of the key tools. Trendline analysis seems like the most basic one.
It is. That's the visual study of rising, flat, and declining trend channels on a chart to identify clear support levels, which is a price floor, and resistance levels, a price ceiling.
Which signal potential buy and sell points based on established market behavior.
Exactly. Then you have the often cited moving average analysis.
The 50-day and the 200-day moving average.
Those are the classic ones. It uses a series of past prices to provide a nonlinear graph of price movements to smooth out the daily volatility and identify the underlying sustained trend.
And when those lines cross, it can signal a major trend change.
It can. Then there are Bollinger Bands, which introduce volatility into the picture.
How do those work?
Bollinger Bands use standard deviations from a central moving average. They act as dynamic boundaries and are used to identify if a stock is overbought. So, hitting the upper band, suggesting a pullback is likely or oversold, hitting the lower band, suggesting a bounce is imminent.
And finally, technical analysis isn't just restricted to stocks.
Not at all. Technical analysis can be applied to fixed income securities, commodities, futures contracts, anything, really, provided that reliable price history and trading volume data is available for observation and pattern recognition.
We've covered risk, we've covered value, and we've covered timing. But none of that matters. All of the previous analysis becomes instantly obsolete if the foundational data you're using is rotten. Our sources identify one critical qualitative element that is the non-negotiable cornerstone of professional evaluation.
And that is corporate governance practices. This is the absolute cornerstone of qualitative stock evaluation because it assures the analyst of the reliability of the numbers they're analyzing.
Without trust in the governance, the whole framework just collapses.
It's a house of cards.
Why do these qualitative aspects override even the best-looking balance sheet numbers?
Because issues like accounting scandals, undisclosed liabilities, and outright corporate fraud can lead to immediate catastrophe and bankruptcy, even if the numerical financials, the P&L, and the balance sheet look strong right up until the moment of collapse.
The numbers are only as good as the people reporting them.
Precisely. If management is unethical, or if the internal controls are weak, the intrinsic value you calculate is based on a lie. Trust in the board, the auditor, and the transparency of the reporting is paramount. It's the necessary step zero before the analyst even thinks about calculating a PE ratio. Hashtag tag outro.
We have completed a very, very deep dive into the complex, structured process that professional analysts use to assess investment opportunities. Let's try to synthesize our key takeaways for you, the learner.
I think the foundational risk concept to internalize is that the residual claim is the defining characteristic of equity.
And it is why equity demands a substantially higher expected rate of return than debt.
Because you are last in line.
And the most effective risk management is dual-layered. Use cross-sectional diversification across sectors and geographies to eliminate that idiosyncratic risk.
While relying on time in the market to combat the short-term volatility.
Third, and maybe most importantly, always remember that crucial distinction between price, a fact, and value, an opinion.
The entire goal of fundamental analysis is to calculate the latter to profit from the deviation in the former.
And finally, remember the analytical loop. Use the EIC framework economy, industry, company to assess the business environment.
Then calculate value using the right model for the job: PB for banks, DCF for predictable pharma, EV/EBITDA for cyclicals.
And then use technical analysis to help nail the entry point.
Applying the EIC framework and understanding these basic valuation tools empowers you to move beyond the market noise and actually look at the underlying health and intrinsic worth of a business.
We established earlier that market risk, which is measured by beta and driven by broad systemic macro factors like inflation, fuel prices, and interest rates, cannot be diversified away. It is inherent in the way global finance operates.
Yeah. Mm-hmm.
This leads us to our final thought for you to ponder. If market risk is driven by these macro factors and is embedded into the entire financial system, what structural economic or political change, beyond merely the actions of central banks, would be required to reduce the systemic volatility in the overall market risk inherent in our interconnected global economy?
That is a challenge that faces every large capital manager today, a big question.